So far so good. We've been able to cover most of the introductory part of this class, and then in our last class we discussed about what trading entails. We talked about what you need to be successful in trading, which we brushed on the knowledge of technical analysis, risk management, and psychology, and we are focusing on technical analysis. Okay, and on that we have been able to look at those things that are very, very important to us. We talked about how important it is that you know what a candle is, and then I brushed on the videos that you've watched before now that talked about candlestick anatomy, the structure of a candle. We talked about candlestick pattern, where we look at the likes of bullish engulfing candle and then bearish engulfing candle. We have evening star and morning star, and so on and so forth. We went further to look at a case scenario whereby these candles are not just one or two or three, but then they are in hundreds or thousands or millions. How do we go about that? And then I tell you that the combination of these multiple candles give birth to what we call market structure. And I also make you understand that market structure is the most important aspect of technical analysis. And having said that, we went further to look at the basis of market structure, where we have been able to decode or deduce what we need to see before we can say that a particular market is bearish or a particular market is bullish. And one of those things we talked about is the fact that a bearish market has two major characteristics. Likewise, a bullish market. One of those characteristics of a bearish market is it has the ability to create lower lows and lower high, and then a continuous break of structure to the downward direction. That is a bearish market. But in case of a bullish market, it's creating series of higher highs and higher lows, and also a continuous break of structure in the upward direction. Having said that, we went further to look at the advanced market structure. And one of the key things I said about the advanced market structure is they put into consideration the concept of liquidity, that the presence of liquidity makes it advanced, and have shown you in our last class where some beginners traders get trapped because they know not about this advanced market structure. So talking about liquidity, we have been able to see that there are a lot of liquidity, but God be the glory, we've been able to simplify this liquidity into three categories, which we call transactional liquidity, like we have in our screen, something like this. I said that when you have a setup that looks like this, we want to see a sweep and a break, and then something like this. This was the basis of the setup we used in case of a bearish scenario, and we said that we have a sweep here, and this sweep, once we have this sweep, we have a new break. Between this point here and this point here, we have our swing structure. So having established our swing structure, we are able to identify what transactional liquidity is, and we say that transactional liquidity is the first break of structure that happens here. Okay, and then we say that transactional liquidity is used for what? Correction. That once transactional liquidity is taken, the next thing we want to look at for is a corrective move, and that corrective move is what we create the most important kind of liquidity, which we call structural liquidity. And the expectation is that price is supposed to come down to take this structural liquidity, because from what we learned, we say that structural liquidity is used for continuation, and every trader who wants to succeed in trading wants to look out for continuation. And so we only want to see that structural liquidity needs to be taken before we can enter a buy or a sell. And for a buy scenario like this setup, we are expecting that this structural liquidity, which is this pivot point here, denoted by this line, price needs to break below it before we can then tend to look for our entry. Okay, so having established all of these bases, we also went further to look at the concept of premium and discount pricing. You see, all of these things that I am saying is just to bring back the memory of everything that you have learned. It's more like I am, summarizing everything that we learned in our last class. And you might be wondering how I'm able to remember this. In fact, you are the one to even remind me that this is where we are, this is where we stop. But because of the fact that I've been in this game for some time, some things have become part of me that I've retained them. And even as I'm talking to you right now, there is no book or any recording that maybe I can say I'm using for reference. But I literally remember everything that I've taught you guys. And between you guys that are listening to me right now and me presenting to you guys, it is expected that you go back to, practice or, look at what you have written down on that day of the class to ensure that these things that I'm saying is what is retained in your head. So if, as I am saying this thing right now, and you are not remembering any of them, then it's a loss for you. And I'm sorry, there is nothing I can do, because whoever is listening to my explanation can actually testify that at least I'm trying my best to ensure that I explain it in a very simple way that everybody can understand. So we look at the concept of premium and discount pricing. And that is when I actually introduced this Fibonacci tool. I told you that I've been able to set up my own, and this Fibonacci tool was developed by a mathematician called Fibonacci. So that is why they named this particular tool after him. They call it Fibonacci retracement. And it is just a tool that they use to observe that, price react to a psychological point in the market, which they refer to as key level or psychological level. So some of this psychological level, they were able to come out with, a percentage formula that says, okay, price is reacting to, some key level in the market. So there are different levels on the Fibonacci tool, but to me, the ones that are very, very important to us to use is 0%, 50%, and 100%. That's why you are saying that you only have this. But in between this point and in between this point, there are other levels. But that is not our concern. That should be for, a thing for another day. So my point of view, or my take, or what I explained to you based on premium and discount pricing is that from a premium zone, above the 50% Fibonacci level, we have a premium zone. That means above here, within this region, this is the premium zone, and this is the discount zone. So we are expected to look for sell setup from this level, and we are expected to look for buy setup from this level. That means that we are selling from the premium level and we are buying from the discount level. So that was what we were able to establish, and I told us that this red line, this 50% that you are seeing, is the point of equilibrium between buyer and seller. Okay, so these are the things that we were able to cover in the last class. Now we are going to step further to look out for POIs. We are going to look at POIs. We're going to look at POIs. We're going to look at POIs and entry. So these are just the things that we are going to look at for. After today's class, if I am able to cover these two things, I don't want to rush it. I may probably not cover everything, but if I'm able to cover these two things, that means that we are going to move to live chat and then try to see how these things can be applied. Okay, so someone should remind me to drop a link that you can use to, for those that have access to laptop, that you can use to you can watch so that you will be able to know how to use this platform correctly, how you can set it up for your own to look very professional like mine, and how you can actually do this analysis. Maybe someone should remind me after this class. So we will be looking at entry POIs and entry today. Now, what is POI? From where we stopped in our last class, we have concluded that there is a thing called premium and discount level, and we are expected to look for entry area from the we are expected to look for either a sell from the premium zone or a buy from the discount zone. But the question is, which area exactly inside this premium or discount level should we focus on? And that is what POIs that is where POIs come in. POI simply means point of interest. That is just what it means. Now, some persons may refer to POIs as area of value, area of interest. The names are not they are not very much important to me as what the meaning is. So ensure you focus on what the meaning is. And my point of view, or what I want you guys to take from this simple explanation, is you don't just buy or sell at every point in the market. There are key levels where you need to wait for price to get to before you can say you want to take a buy or you want to take a sell. And those points where you are waiting for entry, they are called your POIs, because these are the areas that you are interested in. So when you have a swing structure that looks like this, or a market scenario that looks like what I am drawing here, okay, suppose this is a market that you want to make a decision on. Now, to analyze this market, the first thing I told us is you need to look for where your first sweep of liquidity happens, to identify your swing structure, which is that there has to be a sweep and a break of structure. Now, your Fibonacci tool will help you to probably figure out that between this level here and this level right here, we have our swing structure. Okay, so the expectation is, or from what we have learned about premium and discount, is that we should look for a buy entry from a discount zone and a sell from here. That means, by virtues of what this premium and discount is telling us, is if price come in here, we want to look for a buy. But the question is, where exactly inside this zone should we look for this buy? Now, are we just going to click buy once price gets to this level, or are we going to wait for price to come to this zone, or are we going to see? So there has to be a specification. So to understand where this specification will come in under this POI, we are going to look at some key thing which we refer to as supply and demand. We are going to look at order block. We are going to look at order block, and we are going to look at a breaker block. We are going to look at a breaker block, Then last but not the least, we look at what is called the QMR, which means QMR means Quasimodo reversal. Quasimodo reversal. Okay, this QMR. So this is what it means. All right. So this is what we are going to cover. So even if we don't really look at entry today, if we are able to cover this, it's a good day. Okay. So let's start with supply and demand. Now in economics, for those that probably study economics in school, we look at, or let me not take it high so that some of us will not get confused. Now, if you are interacting with your environment in terms of buying and selling, now there is a relationship between what people are buying, the quantity of things that people are buying, and the price of that particular thing. And that is where demand and supply comes in. For instance, we all know, for those who are Nigerian, or I think majority of us here are Nigerian, we've observed that the economic situation of the country is not encouraging, like it's not stable. We are having a high rate of inflation. That means that price of goods and services are very, very, very high at the moment. One of these things that you will notice is people purchasing powers are going to reduce. What do I mean by people purchasing power? The amount of things that people can buy will reduce, because if you have 20,000, maybe like 5 years ago or 10 years ago, when the economies are stable, you will realize that you can do greater things with that 20,000 than when you have 20,000 in our present economic state. So what does that tell you? That tells you that there is a relationship between the quantity of goods that people can buy and the price of that good. Okay, to bring it even to our lower realm, which we can actually reckon with. Let's look at milk for instance. Or what can I use? Okay, let me use rice for instance. Now, there were times where rice, majority, everybody can actually afford rice, but you've seen that rice has become very, very expensive to the point that not every families can actually afford a bag of rice at the end of the day. That is to tell you that when the price of things increases, the demand for that thing be reduced. Do you understand? Just for example, if the phone you are using to listen to me right now, if you bought it at some point where you know that you were encouraged because of you have the ability to pay for it, if you want to get that same phone that you bought probably $10 or $20 or $50, and they are telling you that this phone that you bought for $50 is now $1,000, you may lose interest in it. And as you are losing interest, every other persons in your category are also losing interest. And that's telling you that the demand for that particular thing is actually decreasing, is reducing. So bringing it down to trading, how does demand and supply work in trading? In a nutshell, people buy when prices are low. That is what you should know. That means that if we are taking a buy on a particular if we are taking a buy scenario, we are buying because we saw it at a low price and the expectation is that price will go up. That is just a basic knowledge of what demand represents. Now, in supply, you are selling from a supply level. You are selling from a supply level, indicating that if you don't sell this thing now, prices may drop. For instance, if I have a product like this, and these are different price level. Now this is a different price level on its own. This here is a price level, this is another price level. Now what traders are doing is that as at the time where the price is still here around 20, look at the value here in this zone. Traders will want to buy from here because they understand that the prices are still very, very low, and when they buy from here, what they are expecting is price will go up to this particular level. When price get to this particular level, that means that if they are buying, if they bought probably around $20 here, price reaching this particular point, price may be around $100. That means that they are already making $80 gains. Okay, now that they've already made their gain, they also know that price will not just start going up forever and ever. There will be a day or a time where there will be need for declining in the market. They will also find an opportunity to sell. Now they sold at $100 here because that is the current price of this. They sold at $100 here and they've already made some profit. Now this same price decided to push all the way down. Now they've taken their profit here and price has declined to this particular point. They want to also look for opportunity to buy again. So this is just what is happening in the market. But in the context of what we want to grab, because we are no longer beginners, this is just a layman understanding of what you should have at the back of your mind. Just like they said, the behind the scene of something. That is what is happening. So in demand and supply, what you should just know is that we are buying from a demand level and we are selling from a supply level. This demand and supply are interchangeably used for support and resistance. Okay, so what I've been explaining was supply and demand, and I have been able to explain that what we do from a supply level is that we sell from a supply level and we buy from a demand level. And I gave a schematic that if you have a market that looks like this, probably a bullish market with these characteristics and all, that one thing you should know is that something is responsible for pushing price from one point to the upward direction, and that is a demand candle like this. A demand candle, so this is a supply, because when price gets to a supply zone, market is expected to retrace to the downside. For market to come down like this, that means there is a presence of demand that this market has reacted to. The same thing for price to push up from here, that means that there is a demand that market has reacted to. Sorry, here is a supply that market reacted to. Here is a demand. So anything at all that you see that price is reacting to, and then it is pushing towards the upward direction, you refer to those particular levels as demand level. And if at all price reacted to a particular level and you see that market started dropping or trending in the downward direction, we refer to it as a supply level. And we have established also that this name supply and demand are interchangeably used as support and resistance. So we are diving in to understand what an order block is. And I said an order block can be identified either as a bullish order block or as a bearish order block. Okay, so I have drawn these candles here just to explain what a bearish order block is. That means that if you want to put anything down, the key thing you want to know about order block right now is that it can be a bullish order block and it can be a bearish order block. So we want to go further to identify what a bearish order block is and what a bullish order block represents. Now, a bearish order block is the last bullish candle before a massive drop in the downward direction. I'll take it again for those who are writing. A bearish order block is the last bullish candle before a massive push in the downward direction. Now, what do I mean by that? If you look at this, we have, there are two candles here. We have bearish candles and then we have bullish candles. Now, in these bullish candles, this is the last one before we are seeing a massive bearish candle. So this particular candle here is what we refer to as a bearish order block. Now I've explained what a bearish order block is. The next thing I want to do to establish is why is it important? Why is it important that we understand what a bearish order block is? Just for another recap, for those who do not get it in the first time, this is the last one. Please pay attention. I don't want you to pull me short when I'm still explaining or taking me back again. I've repeated this like this should be like the fourth time now. I said that there are two ways you can identify an order block. You either identify an order block as a bearish order block or you identify it as a bullish order block. Now, I said we want to look at how do you know which order block is bearish and which one is bullish. Now, I said a bearish order block is the last bullish candle before a massive drop towards the downward direction. And I am showing you here that these are all bullish candles. These are all bullish candles and these are all bearish candles. Which one is the last one before you start seeing the bearish candle? This is the last one. So you have been able to identify what a bearish order block is. The question now is, how do you want to trade it, or what is the expectation? What are you gaining? What do you want to use this thing to do in the market? What an order block represents is that, or what a bearish order block represents is whenever in the nearest future, when price eventually come to that order block again, we want to look for a sell-off from there. We want to look for a sell-off from there. So that means as a trader, when you identify a bearish order block, your expectation is that bearish order block becomes your POI. What is your POI? An area where you are interested in to make a trading decision. And this area is because you have seen an order block, and you are willing to make that trading decision. So this order block here becomes a POI. So as I was saying, I said that what an order block helps you, a bearish order block helps you to do is remember that there are two decisions you can make as a trader. It's either you are buying or you are selling. The problem we are trying to solve is knowing where to buy from and where to sell from. And to know where to buy from and where to sell from, after you've understood what your market structure is telling you, the next thing is those specific area where you should take this buy or sell from. And we are now talking about what are those specific area. Those specific area represent or is what we call our POIs. Under these POIs, we are looking for this. Either we are looking for a supply level or we are looking for an order block. I've explained that for market to react or change direction from a particular point, there is a reason. Nothing happens for nothing in the market. There's always a reason for everything. So we are now explaining that an order block can be a good POI. But the question is, there is what we call bearish order block and bullish order block. Now, which is bearish and which one is a bullish order block? And this explanation that I've given to you here tells you that a bearish order block is the last bullish candle before a massive drop in the downward direction. And I went further to let you know that when you identify this order block, you wait for price to come back to it, and you are expected to take a sell from this bearish order block region. That means that this area right here is an area for entry. It's an area where you are expected to, probably take a sell from. So I believe that we are good with this explanation. So let me go further to explain what my battery is. I'm running out of battery, so I'm just going to stop at this order block. I want to explain what a bullish order block represents. Now, the same way, a bullish order block is the last bearish candle before a massive push towards towards the upward direction. So it's the last bearish candle. Okay, so suppose we have this. Like this, like this, like this. So this is market selling, and all of a sudden you start seeing a different thing. This time around, this is no longer a bearish market, it's a bullish market, and you start seeing price trending towards the upward direction in that order. Now, I've defined what a bullish order block. I said it is the last bearish candle. Now, what is the last bearish candle here? This is the last bearish candle. This is the last bearish candle, and after this bearish candle, you can see that price started trending towards the upward direction. The same way I explained this, the same thing follows here. The expectation right now is that price will tend to, play around, but one day it will definitely tap into this, and the expectation is that price will price will reverse from here and start trending in the upward direction. So this is what a bullish order block represents, and this is what a bearish order block represents in the market. So I think we'll stop here, and I believe that this explanation, that means we are buying from this zone, we are buying from here. So this is the expectation, this is the expectation, this is the expectation. So I believe that my explanation is not that difficult, and we all have learned something from this class. So like I said, we'll complete breaker block and QMR in our last class, and then we'll talk more on entry, and we'll go to the live chat to practice everything that we have been saying so far. So thank you so much for your time. If you have any question, please drop it in the group. I will respond to your question, and I will also drop this screenshot in case you want to make reference to it, or in case you will need it to draw it on your note, or maybe wherever place you're actually taking your note on. So thank you so much, and God bless you.